Hello everyone and welcome back to 7-Minute Options. Today I want to talk about the 40 days to expiration Iron Condor that Tastyworks always talks about. Tastyworks has done a ton of backtesting on this, and this is the typical setup. So I just did my own backtest here on getvolatility.com just to show you what it looks like. So if you were to do this once a month, say sell a 20 delta short put, a 20 delta short call, buy the wings. In this particular example, I bought the wings at the 10 delta and I bought them with 40 days to expiration. I set it up so that the backtester buys it once a month on the 10th day of each month. Why did I pick the 10th day? It's because most monthly expirations are around the 20th of the month. So if I buy, let's say on March 10th, then 40 days later will be like the April 20th day for the monthly expiration in April. So that's why it's 40 days to expiration, selling every month on the 10th of each month. And we are going to hold this until either we reach 50% of our credit received or we hold for 25 days. So basically two things will happen. Either we are going to reach half of our max profit target and then we close the Iron Condor, or we reach a point where we have only 15 days left and we just close it. Whether we are ahead or behind, we just close it with 15 days to go. If I look at the results of this backtest for the last 5 years, what you see here is this actually has a positive expected value. So on average, this trade made $18 over the last 5 years. If you do it once a month, every month for 5 years, there you go. See 64 trades, right? 64 months. It's roughly just over 5 years. And what you see here is this strategy wins 80% of the time, loses 20% of the time. And it makes about 18 bucks each time you do it. The way that happens is you get a lot of small gains. You can actually take a look at the expected value here. Every little green line is a win. Every big red line is a loss. So you have about 5 or 6 wins here, followed by a couple of losses, 6 or 7 wins in a row, a big loss, right? Your losses are relatively big and few, whereas the wins are relatively small but frequent. And in this particular example, this actually made money. This is a good strategy. So there you go. The maximum payoff in that 5 years was 148 bucks. The minimum payoff, or that is the biggest loss, was 500. Looking at the histogram here, we see a whole bunch of small wins piling up and a few bigger wins as well. And then these actually are, if you add them up, it's more than the losses you have. So there's a lot of small losses as well in the 80 to 160 range. And you got these 2 big losses out here. And even with those 2 big losses, right, we actually come out ahead. And if you look at the actual history here, the big losses came here in rapid succession. This is the COVID crash, right? So the strategy was doing well for about 4 years. Then you got this COVID crash, which is like a once in a 10-year or once in a 20-year type event. And look at that. The strategy recovered very nicely afterwards and continued to go. But yeah, so you see small increases followed by more sudden decreases. But this is actually a good strategy. So let's see what this looks like if we were to do it in Tastyworks. So looking at the option chain here, this one is 39 days to expiration, but it's a weekly. So I'm probably not going to open it today. If that was a monthly, I would probably open something similar. And if I go to find the 20 delta option, there it is. In this case, it's 21. That's the closest one. So I'm going to pick this one. And the 10 delta is out here. That's the 195. That ends up being $11 by $1,100 at risk, minus the $130 credit. That's how you get the buying power. The buying power in a defined risk trade such as this one, it's always the balance of the maximum risk minus the credit received. Then of course on the call side, same thing. There's the 20 delta. Again, there's no 20 delta in this particular chain. There's a 21 delta there. We got the 11 delta there. But I noticed that this is only $6 wide, so I might as well make this, let's say I can make this, I was going to make it 11 so it matches the one up top, but I can't because there's no 244 strike. So what I'm going to do is I'm going to make, so if this is $6, I'm going to make this $6 as well. So there you go, that's what it would look like. So now my maximum risk on this trade is only $600, but I get to keep the 183 credit. So the balance there's $417 of buying power. I get 3 theta for $417 of buying power, which is very, very effective. If you look at this, we're carrying $600 of risk and we're collecting 183 in credit, which is almost 1/3. It's a little bit less than 1/3, but it's still very good. It's close to that 1/3 magic target that you should be aiming for when you're doing Iron Condors. And so this looks pretty good. Right now, I'm not going to sell it because I don't want to do it in the weekly. As you can see, there isn't a whole lot of open interest in these options. But if this was the monthly expiration, I probably will. So in a week or two, you're going to see me do this trade here when this expiration, this 53-day one, comes down to the 40-day range. All right. Yeah, that's pretty much it. You know what? Why don't we take a look at the one that I just closed recently? So this one, the one that I closed earlier today. We can see the activity. There it is. This was filled at 6:50 a.m. Because I reached a $76 preset 50% range. But there was my short put, there was my short call. Let me zoom in here. My short put, my short call, that's where I was on May 4th when I sold it. And you can see it moved against me and then it moved back. And remember, as it moved up, you can see the volatility decreased. And I was in this trade for 20 days, right? I bought it on May 4th. I closed it out today on May 24th. And if I look at the chain here, the history, you can see it there. I collected $160 in credit and I set an automatic good to cancel order to buy it back at 76, which automatically triggered this morning, and I get to keep my $84 P&L. You might be wondering, why not go for the full, like the exact halfway, the 50%, the 80? Why did I go for 84? Nothing wrong with going for 80. I went the extra 4 just so I can collect the $4 it cost me to open these 4 positions. It's kind of like the transaction cost, but that's just my personal preference. There's no real reason why I did that. But yeah, so this one worked out really well. This is kind of what you want to see. You want to see stock going sideways, and this is how it's supposed to work. All right, that's 7 minutes. See you guys next time.